Hi, this is Yuxi. Today I will present how to use five financial ratios to analyze Bacon Science financial report. The financial ratios are the very useful tools to assess the relevant strengths of the company by performing simple calculation on balance sheet and income statement. I will choose gross profit margin, return on equity, return on assets, asset turnover ratio, and cash ratio as today is presenting. So firstly, I would like to calculate gross profit margin. Gross profit margin equals to gross profit divided by total revenue. So gross profit equals to total revenue minus cost of goods sold. According to 2013 income statements, and total revenue equals to 7,418 minus 5,271 equals to 2,147. Then to use 2,147 divided by 5,271, which equal to 41%. This ratio is very important because it is the percentage by which gross profit exact production cost. So gross margin reveals how much a company earns, taking into consideration the cost that it incurs for projecting its product or service. Gross margin is a good indication of how profitable a company is at the most fundamental level. How efficiently a company uses its resources, materials, and labors. It expressed as 41% and indicate the profitability of a business before overhead cost. It is a measure of how well a company controls its costs. So secondly, I would like to calculate return on assets. Return on assets equals to net income divided by total assets. According to 2013 income statement and the balance sheet, net income equals to 713 and total assets equals to 18,063. Thus, ROA equals to 713 divided by 18,063, which is 3.9%. ROA can help analyze profitability of a company. The higher the ratio, the more efficiently your company is generating profits from its resources. So ROA let an investor to see how much after expenses profit a company generated for each dollar in assets. In other words, ROA measures the company's net earnings in relation to all the resources it had at its disposal. Thirdly, I would like to calculate return on equity. Return on equity is equals to net income divided by shareholders' equity. So shareholders' equity is to common stock plus return earning. Based on 2013 income statement and the balance sheet, net income equals to 713 and shareholder equity equals to 9,620. Therefore, ROE, which is 7.4%. One of the most important profitability metrics for investor is a company's return on equity. Return on equity reveals how much after-tax income a company earned in comparison to the total amount of shareholder equity found on the balance sheet. An increasing return on equity is preferable as it shows the company is more efficiently using shareholders' equity to produce profits. Business owner typically wants to maximize return on equity to sustain or attract investors. Fourthly, I would like to calculate assets turnover ratio. Assets turnover equals to sales revenue divided by total assets. From 2013 income statement and balance sheet, sales revenue equals to 7,418 and total assets equals to 18,063. Thus, asset turnover equals to 41%. The formula for asset turnover ratio evaluates how well a company is utilizing its asset to produce revenues. The higher the ratio, the better. A reading of one or higher indicates the company is generating more than $1 in sales for each $1 in assets. A rising assets turnover ratio over time shows assets are being utilized more efficiently. Last but not least, I would like to calculate cash ratios. The cash ratio is equals to cash plus cash equivalents divided by current liability. Based on 2013 balance sheet, cash equals to 500 and the current liability equals to 2,943. Thus, the cash ratio equals to 0.17. This ratio is useful to creditors when they decide how much money, so if any, they were willing to loan a company. So thanks for watching today, and this is all about my presentation.